Thank you everyone for attending RSG's Financial Wellness webinar. This is part 2 of a 4-part series in collaboration with Rise Private Wealth Management. We're happy to have them today. I'm Kevin Delaney. I'm the VP of Business Development here at RSG, and I also serve as our technical operator for today's webinar. So cross our fingers that everything goes well. But I did want to hand it off today to RSG's own Miss Elvia Sanchez. She is a partner of our firm as well as a senior relationship manager, and her as well as a couple of folks from Rise are going to do today's webinar. So I'm going to hand it off to Elvia to introduce the folks from Rise.
Thank you and welcome for joining Retirement Solution Group's Financial Wellness. We're happy that you could join us. Retirement Solution Group is your financial 401k advisor. We are here to assist with the managing of your 401k plan and as well assist you with managing your 401k accounts. RSG is here not just to service the plan sponsors, but you, the participant, as well when it comes to questions such as signing up, enrolling, how much you should defer, putting a plan in place to how you would like to invest within your 401k and get prepared for retirement. But most importantly, today we are here teaming up with Rise Wealth Management Team. We have partnered up with Rise because they share the same values that we do here at RSG when it comes to the quality of service that we like to give to our clients. So without further ado, I would like to introduce Shanna and Sonia, who will be speaking in part of how we can diversify in today's market so that you can have a well-balanced portfolio. Shanna?
Awesome. Thank you so much. So as Elvia mentioned, we are partnering here with RSG. Super excited to be bringing another educational seminar to you all. Today we'll focus on strategic wealth management. But first, just wanted to share a little bit more about the Rise Private Wealth Management team. So our team's mission is financial advice that brings you confidence, simplicity, and success. So really just trying to take the complexity of finances and really make it simple for all of you so that you have more confidence in your financial plan. A little bit more about our team is we actually operate in over 40 different states with different clients, over 2,500 families we help. We have a large collaborative team that is spread out amongst multiple different states. And on our team, we have many different specialists who focus on investment, tax control, estate planning, and insurance. However, every client that we work with does get a one-on-one relationship. So, just like with RSG, you have a really great team that collaborates behind the scenes, but always that one-on-one relationship. And with you guys, it is your relationship manager with RSG. And for us, our clients have that one-on-one relationship with a financial advisor. And our vision at Rise is to be the most referred and recognized wealth management practice in the industry with a strong community presence. So another reason as to why we're happy today is getting out and being able to share in the RSG community. So today we will talk a lot about wealth management. So we'll embark on the journey to explore the world of wealth management, which is a crucial aspect to financial success and stability. So what is wealth management? Wealth management is the holistic approach to handling an individual or family's financial affairs. So it combines financial planning, investment portfolio management, and a number of aggregated financial services to achieve the client's individual specific financial goals. And doing things, now to be able to make sure that you're achieving those goals over your entire lifetime. What's important as it relates to wealth management is thinking about things that look beyond investment. So making sure that you're understanding the entirety of your financial landscape and what kind of pulls into a good wealth management plan. So it ensures that all parts of your individual financial life are working together in harmony to make sure that you're achieving not only the short-term goals, but also those long-term goals. So thinking about retirement planning, tax optimization, as well as estate planning to help your loved ones. So today we will be covering 4 different topics that all pull into strategic wealth management. So we'll guide you through the key concepts of wealth management, including asset allocation, common mistakes in wealth management, and introduce you all to some tools and technologies that can aid you in building a robust wealth management plan. So with that, I will be passing the presentation over to Sonia, who is going to kick us off with some asset allocation.
Thank you, Shanna. Yep, we're going to dive into asset allocation here. So just initially, want to share this screen, which actually shows you what asset allocation is, referring to the amount that you invest in each asset class. So the main asset classes that you'll see and what most people are familiar with is equities or stocks, fixed income, which are often called bonds, cash, and alternatives. So here on the slide, you can see examples of the mix of these investments, and that this shows anywhere from a conservative allocation to an aggressive allocation. And you can see here how that correlates with those stocks and bonds, right? The conservative is going to have a lot more bonds or fixed income in it, and the aggressive is going to have a lot more stocks or equities in it. So the important piece here, whether you're conservative or aggressive, is having exposure to all 4 of these asset classes and not just going in all in on one investment. So asset allocation is really going to aim to balance risk and reward for you. And in part of doing so, a key component is your risk tolerance. So in general, investments have the potential to generate the highest returns are also going to be a lot more risky or a lot more volatile. So as this graphic shows, we can help you determine your level of risk, as your practice relationship managers can as well. But you really want to look at not only your savings goals, but your timing too. If you have a long time horizon, you have the ability to be a little bit more aggressive. If you have a short time horizon, you may not have as much ability to have market volatility as part of that savings goal. So only you can determine what you're comfortable with, and setting your risk tolerance prior to any kind of market downturns can actually help avoid really some bad decisions in times of market stress. Part of knowing your risk tolerance, diversification is another important key to handling market volatility. So with diversification, you can create a portfolio that has the appropriate mix given your goals, your risk tolerance, your time horizon, and these include those stocks and bonds and cash and alternatives. So by diversifying, you will reduce your dependence on the performance of any one investment. Different asset classes are going to react differently in markets and economy, right? One asset class might be performing poorly and another may do better. So this chart will show how various asset classes have performed between 2009 and 2023. And this was for a moderately allocated portfolio. You can see how no single one asset class consistently outperformed the rest. So not utilizing an asset allocation strategy may expose you to the risk of not achieving your long-term goals. Diversification is something that you've heard a lot already in this presentation, and basically what that means is taking a broad view of your investments in an effort to help reduce your risk in any one area. So a good example of this is a house on a golf course, right? If that house has a really big window overlooking that golf course and you select a single window pane, if a golf ball hits that window, the whole thing shatters, right? But if you fit that window with lots of different multiple panes instead of just one, rather than paying for the whole expensive large glass, You'll just have to replace that one, which will be relatively inexpensive versus replacing the entire thing. And that's actually the point of diversification, is that when you can mix the appropriate investments and put it together inside a overall portfolio, the chances are better that your portfolio won't shatter when a market is in a downturn. So investments that do poorly may be balanced by others that do relatively better. And that's important when creating your plan, is not only that diversification for investments, but also taxes and time. So you'll want to create a portfolio that's aligned to your risk tolerance, both the short term and the long term, and with your tax situation. Naturally, you may have a little bit more risk for long-term investments such as retirement savings than you would for a shorter term goal as like a house down payment or your kids' college education. You may want to diversify your portfolio also based on tax treatments of some of the investments in order to help reduce your tax liability both now and later on in retirement. So an advisor can help you reevaluate those goals periodically and adjust your portfolio accordingly. Making changes to your portfolio in reaction to a market downturn can actually backfire on you. It can lock in losses and reduce your upside potential when markets actually do bounce back. So talking to a financial advisor before you make a decision based on your short-term events or day-to-day market swings is a really good idea. Sometimes that experienced voice can help walk you through your emotions and confirm whether or not the actions that you want to take align with those long-term goals, which actually rolls right into our common mistakes. So here you can see listed the common mistakes include neglecting risk management, so not knowing or not reevaluating your risk tolerance. Emotional decision making, so making a decision based on short-term factors. Sometimes that's market downturns, sometimes that's chasing returns. Overlooking costs, which could harm your long-term return, and a lack of financial planning to put everything together, track and monitor progress during both good and poor market and economic environments. So what should occur is an implementation of that risk management, continued review of your risk tolerance, your portfolio risk capacity, and that regular review of asset allocation. Also rational decision making, having an investment policy statement or something to keep that focus on the bigger picture to make decisions based on logic and your individual financial plan, which also wraps in the comprehensive financial plan to keep you posted on the goal status rather than day to day, and then being aware of what those costs are within your individual plan. So understanding volatility is a common part of the markets that can help you feel more calm about the ups and downs. Sticking with a long-term investment strategy aligned to your time horizon and your risk tolerance can benefit you far more than panicking. As tempting as it is to sell during big downturns, history shows that it's better to stay invested. And you can see here on this slide, markets often see their best and worst days bunched together, hence the volatility. But this chart shows that over the last 20 years, the S&P 500 has actually returned an average of over 10% annually, but not if you miss the market's best days. So over those 20 years, if you miss just 25 days of the market's best days, your average annual return would have been just a little over 2%. So the bottom line is that you want to create a financial strategy that helps you remain calm and gives you more confidence to stick to your strategy. That way you'll be better positioned to avoid the temptation of selling at what might be the wrong time. There's another important reason to stay the course during down markets. The declines are often very temporary. This chart shows negative returns over consecutive calendar years are very rare in the stock market. Since 1929, the S&P 500 has experienced 4 times as many years with double-digit gains than with double-digit losses. So there's only been 3 times in history when the S&P 500 has posted a negative return during consecutive calendar years. And through each of these periods, there were historical significant macro environment events that drove down stock performance. And some of those were the tech bubble from 2000 to 2002, World War II in 1939 through 1941, and the Great Depression from 1929 to 1932. One of the key components for investing is understanding what bull and bear markets are and how that can have an impact on your investments. So stock market investors are bullish when they're optimistic about the economy and when stock prices have risen or are expected to rise. Bear market investors, on the other hand, are pessimistic about the economic outlook, and they usually indicate a fear that stock prices are overvalued and thus headed down. Technically, a bull market is a time when stock prices are trading at least 20% above their recent lows over a period of 2 months or more. Bear markets happen when the stock markets drop at least 20% from the recent highs. So investors might find these swings in market prices disoriented and feel compelled to take action, which can actually be counterproductive. But the good news is, you can see on this slide, bull markets typically last 2.7 years, which is actually a lot longer than bear markets, which actually typically span about 9 months. As tough as it is to watch a bear market decline, there is an upside to down markets. As this slide shows, bear markets are almost always followed by a period of strong price increases. For example, the average stock market return 3 months after the bottom of a bear market is 22.9%. 1 year later, the average returns jumps to almost 50%. If you sell during those bear markets, you may not be invested in time to see the market come back. Remember what we said earlier about how missing the best market days? This can seriously impact your portfolio returns over time. So the best days in the market often occur after these bear market end, which is another reason for investors to stay the course and follow their investment plan in periods of market volatility. So Shanna, you can talk a little bit about tools and technology.
Great, thanks, Sonia. So yeah, as Sonia just highlighted, we'll talk a little bit about the tools and technology that we have available as it relates to wealth management. So modern wealth management employs a range of tools for portfolio management, including software for asset allocation, risk assessment, and performance tracking so that you can make informed decisions. You should also consider resources that you have outside of just the typical tools that are outlined here on the screen. Resources like the team that you have at RSG and your financial advice team that you have at your advisor's office. And an example of how this advice team might utilize tools available on your behalf is being able to run historical data reports on portfolios while they're constructing the appropriate portfolio for you. An example that we at Rise have is our investment manager, Nick Trombetta. He and his team kind of work behind the scenes so that we can build our portfolios using analytics and various tools to conduct ongoing due diligence on behalf of our clients. So recognizing that there are not only these tools available for you when it comes to your wealth management strategy, but also recognizing that you have various resources and individuals that you can be working with to make sure that you have a well-built plan. So while we're on the topic of tools and technology, I definitely wanted to talk a little bit about the act of rebalancing as it relates to portfolio management. So over time, your investments will shift. As some do well, others might not. So rebalancing really just hits the reset button. So the various pieces of your pie are brought back to the size that you had started with. Simply put, rebalancing is the act of selling high and buying low. And you'll see on the screen here, this example is starting with an initial allocation of 50% stocks to 50% bonds. So a very moderate allocation. So with rebalancing, you would sell enough of the stock position to reinvest in bonds so that your mix is always teetering that 50-50 stock to bond ratio. Because here you'll see 1 year after making that initial the initial allocation, the stocks have now grown a bit. So by rebalancing, you're able to take the stock position, the excess 10%, and really reallocate those dollars to the bond side so that you're still maintaining that moderate exposure. So although this may seem counterintuitive, after all, if an investment is performing well, your natural instinct might be to just say, let's buy more, an understandable emotional response. Likewise, if an asset is not performing well, you may be inclined to do the opposite and just sell it. In both cases, you need to push back against those emotional decisions, because otherwise you'll fall into the trap of buying high and selling low, which is the opposite of what we want to be doing to enhance your chances of success within your portfolio. So if you let your portfolio just run wild and say you just left it at that 60% stock to 40% bond mix, now you're taking on a little bit more risk than you had really shot for with that 50-50 stock to bond ratio. So an advisor can help you to make sure you're rebalancing your portfolio when it's appropriate. But a good thing to understand that with the tools and technology we have today, making sure that you're rebalancing your appropriate to your appropriate allocation is available ongoing. All right, so let's talk a little bit about building your plan. So as it relates to wealth management, it's hard to, know right off the bat, okay, this is exactly how I should be invested, or, this is how much I need to save. So really having a plan in place is important. So a few different steps and considerations for you all to walk away with today is, assess your financial situation. So actually understand, what is my financial landscape as it looks like today? Because that's really, we need a baseline. We need to know where we're starting. What are we even doing in the way of our wealth management strategy? From there, it's define our goal. What's the goal? How much do we need? By when, right? Anybody can say, of course, the goal is retirement. Well, retirement might mean one thing for one individual and something completely different for another. So making sure that you have clearly defined goals. And then from there, it's looking at the risk assessment. So Sonia talked a lot about this at the beginning of today's session, is really being able to take a step back and look at, well, how much time do I have? What am I comfortable with, right? No one can tell you how much risk you're comfortable with. So really understanding, where do I fall in line as far as how much risk I'm willing to take on and how much I need to take on. We're huge advocates for taking on the appropriate amount of risk, but not necessarily exposing yourself to too much. Asset allocation. So once you understand what is my risk tolerance, am I allocated today the way that I should be? So understanding how your allocation lives today, and then either shifting to the appropriate allocation right away or having a plan to get to the appropriate allocation over time. Investment strategy. So based on how much risk I'm willing to take on, what that risk assessment told me, and how I'm allocated today. Am I investing in the appropriate products to make sure that I am meeting those goals that I have for myself in the future? And then lastly, it's making sure that you have a plan in place to be regularly monitoring your investment plan. So it's one thing to set up a portfolio and feel like I'm great with that risk today, but as we know, things change over time as you're getting closer to maybe making that retirement transition. Maybe at one point you were more of an aggressive investor, but as you get closer to having to draw down, you should be starting to de-risk a portion of your portfolio. So those are a few steps to take, but things to consider as it relates to your wealth management plan is, obviously the goals that you have outlined, and yes, retirement is one of them, but are there other goals that you have as well, that you have to have a different investment strategy outlined for maybe those shorter term goals? The risk management, so making sure that you're always keeping an eye on how you're allocated and if that remains appropriate. Diversification, I know Sonia talked about this a lot, but it's important not only from an investment standpoint, but also making sure that you're considering diversifying yourself from a tax standpoint, and making sure that you have some tax efficiency within your portfolio. So maybe one investment makes sense to hold in your retirement account, but a different investment makes sense to be held outside of your retirement account. So making sure there's some tax efficiency there. and then really considering estate planning and what is important to you to make sure that your investment strategy is in alignment with that estate plan. All right, so as we covered, the steps to take and the things to consider as it relates to the wealth management plan, you'd also want to be sure that you're talking with your advisor about different investment approaches. So the very first approach to consider is total return. So total return with this approach, it is one of the most common investment strategies, especially for individuals with 20 to 30 years of still working years before you're going to make that retirement transition. So total return when measuring performance is the actual rate of return of an investment or a pool of investments over a given evaluation period. So total return includes interest, capital gains, dividends, and distributions over a given period of time. So this is when you hope most to be buying low and selling high and taking advantage of those returns that the market is offering. It's about taking more of that long view, so it may be an appropriate strategy when you're saving over those long-term periods of time, but maybe not the best strategy if it's a goal of saving for the short term. So one key to total return investing is just making sure that you have the appropriate diversification. This could be a strategy even as you get to retirement for the bucket of money that you, again, won't be accessing in the short term. You still may be taking a little bit more of that total return approach to your investment. So now we'll talk about capital preservation. As the name suggests, the primary goal of capital preservation is to make sure that you're preserving that capital and importantly, help to mitigate loss. So with this approach, your financial behaviors can be just as important as the investments you're choosing. The reason? Well, as you approach retirement, you'll naturally be a little bit more concerned with preserving your retirement savings that you've worked hard for while you're in drawdown rather than accumulation. So we saw in the financial crisis of 2008 just how devastating some of those dramatic market losses can be to a retirement portfolio. So that's why allocating a higher portion of your accumulated savings to this type of strategy may make sense as you are making that transition and actually needing to be in drawdown rather than accumulation. And lastly, we have the income approach. So an income approach is all about picking the investments that generate cash flow. So this is in your plan how you may be planning to generate the cash that you need. So we're thinking now income stream, there's various different sources of retirement income. Maybe there's Social Security, maybe there's a pension, but we also know that with some portion of your portfolio, you most likely will need to be drawing down. So making sure that you have the right investments that meet the income approach strategy outlined. So think of this as, just another layer within the portfolio, because although I talked about 3 different strategies, they're not siloed. And so therefore, a portfolio can actually include a combination of all 3 different strategies, but with different goals in mind, right? Income, obviously that short term, we need the cash now. Maybe we're thinking total return for those dollars that are still really working for you behind the scenes. Capital preservation, we always want an emergency bucket. Maybe we have a major purchase on the horizon. So just knowing that these aren't just standalone strategies and you may have a combination of all 3 within your plan. All right, so just as we wrap up here, just want to, highlight some important things to remember. I know that we covered a lot here, so just making sure that as you're building any type of plan, you set clear and concise goals, right? So making sure that the goal isn't just mentioned, but you actually do the work behind the scenes to figure out like how much time do I have? What is that goal going to cost me? And then being able to come in and build that plan behind it. Assess risk tolerance. So this isn't a one and done assessment. So making sure that you're regularly monitoring that, making sure that, it's consistently in alignment with what your values and goals are, utilizing technology. So maybe it's having resources that have the technology. Maybe it's looking into some software that you can get to build a plan and really manipulate some what if scenarios. I know our clients really appreciate the financial planning software we use because we can kind of conduct those reviews and say, well, what if we retired at this point, or what if we invested just a little bit more, right? And so really utilizing the technology that we have today, and then develop a comprehensive plan. So make sure that you understand, what does my financial position look like today, and how is that going to change over time with maybe contributions that I'm making, maybe with a career change, if I'm making more income and I start investing differently. Just have a plan in place so that you can really look at what does my landscape look like today, and how will that change in time to make sure that I'm achieving those goals that I have. And with that, I will pass it back to Sonia.
Yeah, we just want to wrap up by thanking everybody who has joined us today. As Shanna had stated at the beginning of the presentation, much like RSG, we have offices over a number of different states and then clients that we work with across the entire country. So we're happy to help and happy to be a resource for anybody who might benefit. Please reach out to your relationship manager if you have any interest about anything we could do or any questions about working together. Please reach out to your relationship manager.
Great. And then Kevin, were there any questions that we had?
Didn't we have the?
Yes, we did have a couple of questions today, ladies. If it's okay, I'll go ahead and just take a pause here and offer these to you. So I'll start with Elvia, or you can answer it as a panel. It's totally up to you. But first question that I have, it looks like it came from one of our groups, but it says, the materials today is very interesting. Is there any way for these seminars to be facilitated at my business? And what should I do to try to have that arranged? So Elvia, I'm going to give that one to you.
Yeah, definitely. If this is something that you're interested to bring to your participants, to your employees, reach out to your relationship manager, and that could be Kevin, that could be Chris Underwood, that could be Christy Chang, that could be Judy, or it could be Elvia Sanchez, right? You can reach out to any of us, and let's put in place a date and time, and then what kind of information you would want to be presented to your employees. What do you feel would be the most needed for your particular people, and we could customize that. Shanna, Sonia, anything to add to that piece?
Yeah, I would just add that we've partnered with RSG and various companies, and we can really just tailor to the topics that are of interest to your employees. So just maybe get a few examples of the different topics that they would be interested in us coming to present, and work with the relationship manager at RSG so we can put something together.
That's great. Thank you. The other question that came through looks like it came from a participant, but the question posed here is, I've had success in my 401k using a target date investment. So I went and purchased that same target date investment as a personal investment strategy. Is that appropriate? So I'll start that one with Shana.
Yeah, sure. So it's important to know that the team at RSG does their due diligence and really works behind the scenes before they're presenting any of these investment strategies. So your lineup of funds, there has been a lot of work behind the scenes, a lot of research that goes into that before those are offered. So as far as making sure that you have some diversification, a target date fund is great. As far as investing in a target date fund across the board, maybe not so much. So we know that RSG has done the due diligence with the funds that are in your plan. But if you're buying a target date fund outside, it doesn't necessarily mean that you're getting that same exact exposure. And it doesn't necessarily mean that the same due diligence has been provided within that fund. So I would argue that working with RSG and utilizing their funds within the 401k is great. But when you're investing outside, don't make the assumption that all of those funds are built the same way. So working with your financial professional is definitely something that we would advise on as it relates to any funds outside of that retirement plan with RSG.
That's great. And Elvia, do you have anything to add to that?
I would say once it comes down to the participant level, their needs, it needs to be more customized, especially if you're looking for outside assets, because you do have other needs. It could be a college, plan. It could be an individual IRA or a 401k, could be an annuity, whatever those needs are. When it comes to that participant that's outside the 401k, you really have to come down and look at what those needs are and customize. So I do think at that point in time, looking at your whole account holistically is a better way and a better approach of choosing investments, the product, and how to diversify that across all of it, not just one single area. So no, I do think at that point in time, if there's questions of those or that you want something more customized, give us a call. We'll get you in touch with the right people and help you through this process to get those needs addressed.
That's great. Thank you very much. Well, I think that's it for questions, ladies. So I want to thank you today for your time, and the information I thought was fantastic. So thank you very much, Sonia and Shanna, for joining us today and for your collaboration with today's financial wellness webinar. Elvia, any last words?
Just realize that RSG is here to help you out. You do have, right, your relationship managers. If you have any questions when it comes down personally to your 401k accounts or next steps, reach out to them. That's the first place to start out. And then we can work from there to fulfill that need that you have.
That's great.
I do want to say thank you to Shanna and Sonia. Appreciate you guys on this webinar, and it's been fantastic.
Thank you.
Thank you.
Well, have a great day, everybody. Thank you very much, and enjoy the rest of your day.
Bye-bye.